Strong day for stocks following another tariff delay. And with May almost in the books, the question now, how to play the markets into the summer. Let's ask Richard Saperstein. He's Treasury Partners founding principal and CIO. Welcome back. It's good to see you.
Thank you.
Speaking of, so if we look ahead to the summer, and we use today as a sort of a guide point, are we supposed to now buy the bark, so to speak, like buy the Trump bark about tariffs because we don't believe that the bite's actually going to happen?
The bite could happen, but it's important for investors to look past the tariff turmoil and look at the environment where we'll have deregulation, more onshoring. Think about the tax bill, immediate expensing from a tax basis, greater opportunities for M&A. So the environment post tariffs will be a great environment for investing. Now, in between that, we have uncertainty, which could cause a slowdown in the next 2 quarters. So I think that the DOGE cuts might have an impact, but I would look to the environment post-tariffs into 26 versus looking in the immediate volatility.
So you're looking through all of it?
Yes, that's how you have to invest in this period.
But what about the back half of the year? Are you looking past that too and just now solely thinking about 26?
Yeah, we've been adjusting asset allocations, and we have some cash. We still maintain very high equity positions. But as you know, we've been purchasing a lot of municipal bonds.
Still?
Yeah, still. The opportunity is still there.
When does that? What stops that opportunity?
The rates plummet below the 10-year Treasury rate. Right now, it's above the 10-year Treasury rate, so you're getting over 100% of the taxable rate in a tax-free security. Second, if the economy slows in the back half of this year, rates will go down, and those bonds will outperform. We're also reducing small cap exposure and actually adding to, as you know, we've been long-term holders of large cap tech.
So I know that, but reducing, did you miscalculate something with small caps to think they're going to do better than they have?
Yeah, typically we were, diversified across the cap table. And what we've been observing in the last few years is that small cap has been underperforming, probably for a couple of reasons, meaning a lot of companies are remaining private for a longer period of time right now. Mm-hmm. And so then when they go public, they're not small cap. They're multi-billion-dollar companies in the large cap space. Secondly, the small caps that are doing very well, they're emerging to become large caps. So we're finding underperformance in the small caps, so we're reducing exposure there. We've been gradually doing it, but we're actually repositioning those funds into large cap tech, adding to our positioning.
I mean, higher rates are an issue too, right? And that's every time rates go up, yes, the Russell goes down.
Correct. It's inversely related to interest rates. But that's not to say that if we get a slowdown in the economy...
That's not good for small caps either.
Exactly. So there's good reasoning for us to be, within the context of an overall asset allocation portfolio, reducing our small caps.
What about rates in general? I mean, they obviously were making the market nervous every time they started to back up. Is that still one of the most important things that you're watching?
Look, for the last few months, all I'm hearing is the end of American exceptionalism, capital outflow, dollars crashing, rates are going higher, we're getting tariff-induced inflation. I don't see any of that occurring.
You don't?
No.
Why not?
If you're a large investor, if you're the Norwegian sovereign wealth fund, where are you going to put your money? You're going to, the size of German stock market is the size of Apple. So where are you going to put $500 billion or $250 billion? You need the American markets for liquidity. And in terms of exceptionalism, where is their growth? The growth is in United States technology stocks. Sure, there are some around the world. But for the most part, if you're a large investor and you want growth, you've got to own U.S. large cap tech.
Okay, so then there's a bid under these stocks for the foreseeable future, in part because of that.
For extended periods of time. Think about this. The S&P's operating cash flow is, 5.9%. The 8 stocks I follow in the large cap tech space, the operating cash flow is 5.7%. So it's virtually the same as the S&P, so why not own the stocks that are growing the fastest?
Why don't you own NVIDIA? Why don't you answer your own question?
I can't own every stock out there.
No, but come on, man. That's a standard answer when somebody just missed it.
Well,
why don't you own that one?
Well, because I'm I'm long a lot of the stocks that are benefiting from data center growth and expansion. And think about, I've got a huge overweight in some utility stocks, right?
Yeah.
And they
like Vistra
and NRJ. And NRJ.
Yeah.
The two of them. And they've proven to be very correlated with data center build out, which is probably part and parcel to how NVIDIA is doing.
You missed NVIDIA? Is that?
Yeah, I missed NVIDIA.
All right, that's good. That's what I was just trying to get you to say.
Yeah, I
Come
missed
on, man.
NVIDIA.
I'm gonna raise you up.
Okay.
Knock you down a little bit.
That's okay.
Saperstein.
But we get our fair share of great allocations and equities.
You do. That's why you're always on the list of Barron's top advisors. So thank you.
It's my pleasure.
It's Richard Saperstein back here at Post 9.